Bloomberg Audio Studios.
Podcasts, radio, news.
Well, joining us now is Jenny Johnson, Chief Executive of Franklin Templeton, which oversees around $1.7 trillion in assets. And I have to say it's cold. Colder this morning than yesterday, but at least it wakes us up to try and understand and figure out the world economy and everything that goes with it. Jenny, thank you so much for joining us. A lot of the participants here were looking at the inauguration. A lot of the bankers here and the world of finance is expecting deregulation and Donald Trump to not kickstart because the economy is doing okay, but actually better the economy in the U.S.
Well, I think that's right. I think, the view on Trump is that, and he's been very clear, he wants less regulation. I think he said he's going to, for every new one enacted, take away 2 regulations. So I think that's positive for business. I think that he'll continue spending, which, is positive in the short run for our economy. I do think we have a concern with the debt. And, I think he'll extend the tax cuts. So I think people view that as all positive. Obviously there's a lot of rhetoric around the tariffs. And, the reality is actually, I think 2 things. One is he's a deal maker. Right? And if you're a deal maker, the first thing you do is you show your powerful stance. So you make a broad statement, I'm going to tax Canada and Mexico by 25%. Well, and then you sit down at the table, you get them to the table, and you say, this is what I need. I need some help on immigration. I want you to import more of our goods. And so, I think we've seen that that's his kind of approach. He makes big, broad statements. I'm going to buy Greenland. And then from there, goes in with a more kind of practical deal approach.
But Jay, is there a danger that actually if you're a CEO, you don't invest because you're never quite sure what's policy and what's negotiation tactics?
Oh, I think that most people have a clear, I don't know, most people have a clear understanding. I think, you understand under the covers because he makes his statements. In Europe, right, he wants Europe to import more from the U.S. He wants, particularly energy. He wants help on, funding from NATO as far as military funding. He probably wants them to lay off a little bit on the tech companies. I mean, so there's an understanding of what his desire is. And so, then you get to the table and you start to negotiate those things.
I mean, is it impossible to know whether he's better for private markets than public markets?
Well, I don't necessarily. I think I think the view is that he's going to be good for the economy, and that therefore is good for both public and private markets.
What are you seeing in private markets right now?
Look, I think you're starting to see more movement on IPOs, which is good for the private equity business. I think that the areas that I'm most focused on or that I think have tremendous opportunity is secondary private equity. There's just been so much deployed in private equity. There hasn't been that kind of liquidity ability. There's been about $150 billion deployed in secondary PE, and we're still seeing, Lexington Partners raised a fund. They closed a $22.7 billion fund last year. I think they've deployed about 70% of it with very large discounts, almost 60% more than the average discount historically. So secondary PE, we also think real estate debt's really interesting. Banks aren't able to lend. They're clogged up with office. Regional banks were the big real estate lenders. And so as they haven't been able to lean in, those private credit managers who have real estate expertise can fill in that void. And Benefit Street Partners, has about $9 billion in real estate, and they think it's a really interesting opportunity.
Mainly in the U.S., or are there also other parts of the world where you could actually see distress?
Yeah, I think in the secondary PE space, you're seeing it all over because there's a need for LPs to get their liquidity. I think in the real estate, that is more of a U.S. issue. Look, I think office all over the world, has issues, but it's B office space, not A office space. But in the U.S., it was the regional banks who were the primary lenders, and they're just not able. Capital requirements have changed in the U.S., and so they're just not able to lend like they used to.
There's also so much talk about, crypto being at the center of the Trump administration's kind of second mandate.
Did you participate in the Trump and Melania meme coin or whatever?
I haven't, but this has everyone excited. They were even talking about it in Davos. Does it change appetite for ETFs? Does it change, the market liquidity in some places, and does it impact basically your company?
First of all, I think it's really important to think of blockchain as a technology. Right. It's a programming language, right, that does certain things really well. I do think that it's likely that ETFs and mutual funds will ultimately be built on blockchain just because it's an incredibly efficient technology. And then there's the crypto world, some of which I think has tremendous opportunity, and some of which I think it'll be noise. It'll be a little bit like the dot-com era. there when, eventually you had some of the biggest companies of the next decade that came out of it, and then you had a lot that kind of blew away to the side. And so I think the crypto world is similar. I think the thing with the Trump administration is we're going to start to see them converge more, the TradFi and the crypto, which is something that we need. We need to have some sort of regulatory clarity so that you can bring these together, because fundamentally it will drive out costs, and there is great innovation that the technology enables.
But is that going to be overlaid by inflation?
Well, so in inflation, I do think that if I were to predict, I think that you could have at the end of 25, the 10-year at 5%. And by the way, from 1950 to the GFC, kind of the neutral rate on Fed funds was about 4%, and the 10-year was 5%. That's actually much more normalized. I think that's what we're going to see. And I think that the Fed is going to pause right now. They're going to try to, this gives them time to see how Trump's policies impact the economy. Some of them can be inflationary. And let's face it, the U.S. consumer is still very strong. The inflation numbers, unemployment's still pretty low. So the inflation numbers are pretty sticky. And I just don't know that we go back to that period of much lower interest rates.
But that again changes everything, which is maybe why you're seeing opportunities. Probably, if you're higher for longer.
So, but kind of more normal for longer, right? It's much more of a normal rate. And I do think that, for example, on the private equity side and private market side, look, it was easier to make money when cash costs nothing. Now you have to be very skilled, because your carry cost of, say, 5 to 8% means that your investments are going to have a drag on them, and so you have to be very good. And so I think you'll see those who are skilled, and others will fall away.
Jenny, for the integration of Western, how's it going? I know you've started with some big chunks of it.
we are working through the integration of Western, yes, and that we've done it. I think now, when we bought Legg Mason, it was actually like buying 7 managers. Plus, we've been integrating Putnam Investments, and then we've done. There's less integration that happens on a private market acquisition than a traditional acquisition, and so we've been methodically going along, and so we're in that process.
And so it's going to plan? Is it quicker than expected? Slower?
It's probably quicker than expected, because we were not planning to do it until after July 25, and now we've started that process earlier.
And are you happy with the progress so far? I mean, you started earlier. Will it finish earlier? And is that a positive for your clients?
I think it's definitely a positive. I mean, look, our whole model is to keep the investment teams independent and to build scale around them. And it's become even more important. Actually, one of the acquisitions, it was actually our private credit manager said, when Franklin bought us, we thought they'd help us on distribution. But now that I see what's happening on AI and the cost of data, I realize we could never participate at this level without the kind of scale and breadth of Franklin Templeton. And so that's what we try to build at the center, and then leave the independence to the investment teams.
And I know, Jane, there's been an issue, of course, with one of the managers there. Any updates?
We are still working through it, yeah.
Okay, Jenny Johnson, thank you so much for joining us. The first Davos, actually.
Yes.
We have to catch up at the end of the week to see how's it been going so far. Fun?
So far, it's great. Yeah, no, it's good to be here.
There you go, Jenny Johnson, Chief Executive Officer, of course, of Franklin Templeton.